G'day, my name's Ben Everingham and I'm the director here at Pumped on Property, and in today's video I'm going to talk about the 18-year property cycle. And I'm not just going to talk about it, I'm going to explain it, I'm going to break it down, and I'm going to teach you how you can actually take advantage of it. So I'm going to talk a little bit about Fred Harrison and Phil Anderson, and those are the two guys that have sort of come up with this cycle and this strategy. I'm going to talk about why 18 years. I'm going to break the cycle down into a series of steps, and I'm going to show you how you can actually take advantage. So when should you be buying? When should you be selling property and stocks in relation to this? So for any of you who haven't watched my videos before, welcome to my channel. My name's Ben Everingham and I've helped my clients buy over $200 million worth of investment property in the Sydney and the Brisbane marketplaces. So this is some of the stuff, the behind the scenes stuff that we use as insiders in the property industry. Today's the first time I've ever actually drawn something, so I've got my little colors over here. I hope you can see it okay, and really excited to get started. So who is Phil Anderson and who is Fred Harrison? Fred Harrison wrote a book called The Power in the Land. Now, I think he wrote that book in 1983, 1984, and he actually predicted the next economic collapse, or GFC at that time. 6 or 7 years before it actually happened, he published that book. And what he'd done is he'd looked at the history of the European markets, or the UK market, in terms of the booms and busts related to property over a 300-year period, and he'd found a pattern in that history, which is very interesting, because a lot of people think that you can't predict the future, and I don't believe you can. But what you can do is you can remember the past, and the same things, if you look enough at the past, seem to continually happen in a very similar order, regardless of what's happening, at least since they brought on a centralized banking system. So his book is The Power in the Land. I strongly recommend you read it. You're at a massive disadvantage if you haven't. The second person sort of took over from where Fred left off, and his name was Phil Anderson. Now, he's one of Australia's leading economists. He's a cool guy. I met him recently when he was in Brisbane, and I email him regularly to ask him questions about the Australian marketplace. Now, Phil wrote a book called The Secret Life of Real Estate and Banking, which is a fantastic read for any of those like me who are absolute nerds and want to understand this stuff so that they can take advantage of it and set themselves and their families up for the future and the rest of their lives. Now, Phil's book was a little bit different than Fred's. Fred was looking at the UK market. Phil was like, well, that's interesting for the UK. Is there any correspondence or relationship between that and the American market? And so Phil looked at 245 years, I think it was, or 250 years worth of data in America, and what he found was a very similar pattern to what Fred had found, where property markets boom and they bust about once every 18 to 19 years. So Phil went to the next level and actually created a property clock in relation to this. Phil's very open about his philosophy. He's got a fantastic newsletter that you can subscribe to at Port Phillip Publishing, and he's just a really down-to-earth sort of guy that really understands cycles and how to take advantage of market conditions. Now, why 18 years? It's a really good question. Phil sort of suggests 18 years because if an average product was to get a 4 to 5% return on investment, it's basically a period of somewhere between sort of 15 and 18 years for that product to double in value. So it seems to be, roughly the time it takes for everything in society to double in value, whether that's the stock market, whether that's the property marketplace, etc. So, just use that as a rule of thumb. Sometimes it could be 15 years, sometimes it could be 22 years. But what Phil discovered, that over the course of his 250-year history, there was only one time where this cycle didn't work, and that was during that period of the Second World War. So obviously the whole world was at war. People stopped speculating in property and stuff like that, and focused on survival. So let's talk a little bit about the cycle now. So at this event that I was at in Brisbane, Phil was there. There was another financial planning company called Cannon Flack, and they had a really nice way of breaking it down. Now, I've seen it broken down in different ways, but effectively the cycle looks a little bit like this. So we start from here, which is number 1, and which is effectively the last GFC. That's the bottom of the GFC, and that is the ideal time to be buying property if you can afford to be buying at that time. Now, we seem to go through this period of time where the marketplace goes up, then it temporarily dips for a period of time, then it goes up again, then it goes crazy up, and then it comes right on down again. And then we start all over again and the cycle repeats itself. So this period of time between 1 and let's call it 8 is effectively an 18-year period of time, give or take, like I mentioned. Now, why this is important to understand is there's very, very specific times to buy. And if you're an investor that sells, then there's very specific times to sell. Now, the problem with most people and the way that they invest is that they sell at the wrong times when everybody is freaking out, and they buy at the wrong times, which is when everybody else is buying. Now, let's look at Sydney for an example. Over the last 46 years, the average property in Sydney has gone up in value by 9.5% per annum. But there's been periods over that 50-year period of time where property prices have gone up by 30% in 1 year. There's been periods of time where property prices have gone down 15% in 1 year. And there's also been periods of time where it's done nothing. So for the 9 years up until about 2012, property prices in Sydney did an average annual growth rate of just over 1% per annum. Now, people have this short-term memory when it comes to property, and for whatever reason, they forget their history and they forget that history repeats itself. So, you know, what we saw in Sydney over the last sort of 7 years since the last GFC, and let's say that the GFC sort of started to finish up there, like the bottom was around about 2009, 2010. Now, in Australia, we didn't feel it as severely as they felt it in America, but it still did definitely have an effect on the marketplace. And so, you know, Sydney's just sort of come through this first phase, which is between 1 and let's call this point here 3. Now, this is also where Melbourne has just come through, and what we see in Australian property is that generally after a GFC, the Sydney and the Melbourne markets always recover first. Now, the reason they recover first is because they have the largest populations, the largest influx of interstate migration generally. They also have the largest influx of international migrants. They're the biggest cities with the most diverse economies. So the diverse economies that, you know, have all sorts of different ways that they make money with strong population growth and an undersupply of housing generally perform best first. So this is really the time that I think between 1 and 3 o'clock you really want to be buying Sydney and Melbourne. Now, as you can see already, Sydney sort of topped out in about 2017. I was calling that in my videos in 2015. Melbourne, which I've been saying for the last 6 to 12 months in my videos, has now topped out and is starting to decline as well. Now, this period of decline between 3 and 4 in the Sydney and Melbourne markets generally lasts for somewhere between 18 and 24 months. So I think that prices in those marketplaces could drop anywhere between 5 and 15%, and in some instances, you know, it could have dropped even more than that in the Sydney marketplace, particularly in the premium end of the market. Now, this isn't something to freak out about, because if you're a smart investor, you buy in the Sydney and the Melbourne markets at the start of that. It's just the people which buy in that last 12 months. Think about buying in Sydney between 2016 and 17, or in Melbourne, you know, right now, which is sort of 2018. We call that little last phase when people aren't buying logically, they're just buying because they're scared of missing out, the winner's curse. And that's generally the phase where you pay, you know, top dollar, and then the market starts to cool off and decline immediately after that. And that can send some people into negative equity. But generally we find this correction in the Sydney and Melbourne markets to be not so severe. What might happen between 3 and 4 is that prices might stabilise in some of the other marketplaces in Australia. Now, Heron Todd White produce a great report on this each month in terms of where the different markets are at. BIS Shrapnel, which is probably Australia's leading forecaster for property prices and most respected, came out with an article on the ABC's website 2 days ago, which is what they believe is going to happen over the next 2 to 3 years in the Australian economy / property markets. They have tipped Brisbane to outperform everything else, growing by roughly 13% on average over the next 3 years. Obviously, there's going to be suburbs that do nothing. There's going to be suburbs that do 30% over that time. But what they did highlight is that Sydney and Melbourne should correct, if not sit flat, probably decline a little bit, which I think is a freaking awesome thing. And if you knew this stuff before buying at the wrong time, then you can, make sense. Now, in terms of the buying opportunities for investors, actually, let's finish off explaining the cycle and then we'll go from there. Now, we call the top 7, and we call this period here between 6 and 7 o'clock the winner's curse. Now, the winner's curse for me is, to a lesser degree here, sort of in between 2 and 3 o'clock, when you buy just before the Sydney and Melbourne markets decline. And then the winner's curse, which has a severe effect on people, and this is when people actually get really, really unstuck from a property perspective and a share market perspective and a business perspective and go bankrupt, which is just before the major correction. This is the winner's curse. Now, you don't want to be strategically buying, if you're an investor, in the wrong markets at these times. Now, obviously Australia is a big economy. Sydney and Melbourne generally come out of the GFC fastest and first off the gates. Brisbane has really done nothing up until this point. It might start to do a little bit during this declining phase in the Sydney and Melbourne markets, but I think where the major regional markets in Australia and the other big city markets that are not Sydney and Melbourne do very well is this period of time between sort of 4 and 6 o'clock. Now, this is historically, if you look at the data, where the Brisbane, the Canberras, the Perths really come into play, and they start doing some much better numbers. Now, what you want to be doing, I think, as an investor at the moment, is completely avoiding the Sydney and Melbourne marketplaces. For now, I wouldn't even be touching them personally until the next GFC, because if you know your history and you overlay this to the year-on-year data, Sydney and Melbourne just, again, I think they underperform in comparison to Brisbane over this next 10-year period we're about to come into. In 10 years' time, we can be watching this back and time will tell, but based on history, Brisbane is set to perform, according to CoreLogic and the Australian Bureau of Statistics data, statistically significantly better than what Sydney and Melbourne are going to do, particularly over the next 5 years. So I use this opportunity between 1 and 2 o'clock to buy as much property in Sydney and Melbourne as I can after a GFC, when you can literally buy stuff not on the open market but from the public trustee, from the banks, from the solicitors, where when people are going bankrupt or no one else has got money to buy high quality assets in Sydney and Melbourne in the first stage of the cycle, which lasts for about 7 years. Then you take a breather on Sydney and Melbourne. You wait for the next major GFC before you get back into those markets if you're a really sophisticated investor. And now at 3 o'clock, going into 4 o'clock, which we've started to see in Australia over the last 12 months, and we'll continue to see, I think, up until about 2020, is the period to start, while a lot of people are scared at the moment, when people are sitting on the fences, that is the buying opportunity. So I've been picking up high quality assets now in the Brisbane market in preparation for this period of time. So 7 years at the front, sort of 18 to 24 months here, 4 years here. And you really only want to be buying between 4 o'clock and 6 o'clock before every single person in Australia gets on the bandwagon from a property in a share market and a business perspective in this winner's curse phase. Now, if you're going to buy property, it's between now and it's between about 2023 in Australia, and then you want to be consolidating. If you're going to sell properties, you don't sell them during the winner's curse when prices are still going up dramatically, because finance is already getting harder to get. And you know, it's it's just so easy to see the patterns once you start understanding this stuff properly. You really don't want to be buying at the winner's curse because the correction is severe and you'll definitely go into negative equity when that happens. Now, remember, Australia didn't have a GFC, but Australia has been following this American 18.5-year cycle for 150 years. It's just the last GFC we artificially got out of it because of the resource boom and because the government was in surplus. Next time round, we're going to be in big debt and we're going to have a major correction. Now, like I said, property prices in this mid-cycle slowdown stage of Sydney and Melbourne, I'm just going to use a different colour there, can drop somewhere between 5 and 15% in Sydney and Melbourne. I don't think it's going to have too much of an effect on the markets like Brisbane that have literally done nothing for 10 years. Like Brisbane's done something like 0.9% per year for 10 years. But if we take a longer term view, over the last 50 years, Brisbane's done 9.7% a year, which is better than Sydney and Melbourne. So remember your history, because just because Sydney's a winner right now or Melbourne's been a winner at the moment doesn't mean that it's going to be the winner always. And then when we get this correction here from the very top of the cycle, which is it was called the GFC last time, it was called the recession we have to had. You know, before that it's been called so many different things, the Great Depression at different times. Property prices here can drop by anywhere between 20 and 50%. Now, don't stress out about that. You know, it hasn't dropped that dramatically in Australia for a long time. I think in 1890 there was a drop of 90% in the property prices in Australia after the gold rush, but that was probably a fair, you know, balloon that had been built and popped before that point because there was money going everywhere. But this is the time to sit on the sidelines, go on your holiday. Generally the share market starts to bottom out and correct first, and then the property market. So in terms of the buying opportunities, you know, as an investor, I like this period of time personally. If we're talking Brisbane, I like this point in time or this point in time. If we're talking Sydney or Melbourne, I absolutely never buy in the winner's curse when everybody is buying. And I certainly wouldn't have bought Sydney or Melbourne at any point since 2015, knowing what I know. So I hope that's given you a bit of an idea about the marketplace and the overall trend. Timing is the most important thing. Now, most people don't have patience and wait for these opportunities to come up, but I think there is exceptional buying and opportunity in Brisbane over the next 3 to 4 years, and there'll be great returns to be had for smart investors that understand this cycle. So overall, I just want to recap on that. Effectively, we come out of a GFC, we get a really good sort of 7-year run, 5 to 7 year run in the Sydney and the Melbourne markets. Those markets start to come off a little bit. You know, generally the other major regional markets and cities in Australia don't do so well over that period of time. Then we come into the second half of the cycle where your Brisbanes, your major regional markets that haven't performed extremely well come into their own, your other capital cities. Then we get the winner's curse where there's no living memory of people in the marketplace that went through the correction and that went bankrupt, and all of the young guys that were in the banks in the last correction are now out of the banks, and so you've got this whole new generation of speculators in there and young kids running the stock market that have no idea about the last thing. Like, they remember it, they've been taught about it, but they forget about it. We get this correction, and at the bottom of the correction in the GFC is your once in a lifetime, twice in a lifetime buying opportunity. So if you're only going to work for somewhere between 20 and 50 years, you know, you only get the opportunity to buy in the major correction a couple of times. That is where shares can drop by somewhere between 40 and 70%, where property prices can drop by 20 to 50%. Everything goes on sale. Nobody has money at that time, and you know, it really is the way to set up your financial freedom. So in terms of, you know, how to take advantage of all of this, it's very simple. You sell at the tops of marketplaces if you're selling. You buy at the bottoms of marketplaces if you're buying. You understand that Sydney and Melbourne generally come out of a recession like a GFC first. Then we have a little bit of a hiccup around the mid-cycle where the stock market could take a beating. I think at some point in the next 3 years, the stock market could drop by between 30 and 50%. And then it comes, and the property market in Sydney and Melbourne particularly could drop for a little while. A lot of other markets in Australia might sit flat for a couple of years. You know, BIS Stratton will predict Brisbane to be the top performer in Australia through this mid-cycle slowdown phase that we're going into. It represents a great buying opportunity because a lot of uneducated people will sit on the sideline, where educated people like you and I are taking full advantage of this stuff. And you know, so buy at the bottom, sell at the top. Understand that you buy Sydney and Melbourne first after a GFC, and then you buy your Brisbane after that. I'm a Sydney, Melbourne and Brisbane guy. I can't imagine ever investing outside of those three markets because that's where 75% of Australia's population and job growth is coming. That's where all of the people want to live. That's where all of the big bucks are earned. So I hope you've enjoyed today's video. I've talked a little bit about Phil Anderson and Fred Harrison. If you want to understand this stuff in a lot more detail from guys who, you know, understand this stuff and have written about it and spent years and years creating that content, go read their books. I've also talked about the cycle a little bit and how you can take advantage of it. So like I said, 7 years from now, I expect the Sydney you know, marketplaces and Brisbane marketplaces and Melbourne marketplaces to be in relatively good shape from where they are now, heading into the next recession type thing. I think there's a big opportunity, particularly in Brisbane over the next 7 years, for smart investors. You know, if you look at this 5-year period that we're coming into and overlay this 18-year period or 20-year period of time using the core logic data, I think the last time we're at this period of 5 years, or going into it, Brisbane, Adelaide, Canberra, Perth all had exceptional runs, and Sydney and Melbourne had very, very poor runs. So good luck with all of this stuff. I hope I haven't overcomplicated it. Definitely didn't mean to scare anyone with this stuff. It is a great time to be buying Brisbane. It is a horrible time to be buying Sydney and Melbourne right now. You know, get educated, learn to understand this stuff and apply it as an investor. So for any of those of you that would like a hand actually with your property investment strategy, or to actually go and buy properties, I run a buyer's agency business called Pumped on Property, where we've bought over $200 million worth of property for our clients now. I've also bought 11 properties for myself using exactly this, buying in Sydney first and the Central Coast, and then cashing out of those marketplaces in 2016, late 2016, using this model, knowing that it was going to happen early, and then moving the money into the Brisbane marketplace, which is starting to do some really interesting things in certain pockets, but on average not good at the moment. You know, while money's hard to get for some people right now, jobs look good, interest rates look good, they're still bringing 300 to 400,000 people a year into the country. You know, business doesn't look too bad at the moment. Wages, once we start to get a little bit of inflation, might start to go up. You know, it's just one of those things. You can sort of put your head in the sand and not do anything about it, or you can really take advantage of this stuff. So I'd love to offer you a one-on-one strategy session where either myself or my brother Simon will talk to you about where you are, where you're looking to go, how you can use this type of thinking to absolutely set yourself and your family up over the next 20 years. It's always a long-term strategy with us. There's no such thing as getting rich quick, but if you know the times when markets do perform better and when you can buy better, then you're at a significant advantage to a lot of other people that go and read the Daily Telegraph and they pull a little snippet line out of somewhere and freak everybody out, or they do the complete opposite of that, is tell everybody to buy and everything's amazing when it's actually shit house, which is what they were doing in 2016. Now that's not selling papers anymore. They shouldn't have been telling people to do that at that time. They should have been telling people to stop buying in Sydney and start looking at other markets. But you know, they just do shit to sell papers. They just jump on the momentum bandwagon or create the momentum based on where they're at. So jump over, have a free strategy session. We'd love to learn more about where you are. I've also recorded another video if you're interested in this sort of stuff. around what I learnt from Phil Anderson after going and meeting with him in person, and also our 2 properties to financial freedom video, where we talk about you don't even need capital growth or timing the cycle to achieve financial freedom over a 15 to 20 year period of time. You can literally just buy 2 high quality houses, build 2 granny flats on those places, and then figure out a way to pay them off, which we can talk about in a shorter period of time, and get yourself and your family financially free so that you've got those choices. So I wish you all the best on your journey, and thanks for your time and attention today. See ya.